Hi class, today we'll be covering chapter 4, problem 4.5b, and we're going to do this problem in parts. So we're going to have a couple of different videos that we have to do for this problem because it's such a lengthy problem. It's going to take us a few video recordings. So I'm going to share my screen with you right now, and we're going to go to Cengage. And you should be able to see problem 4.5b. And what we're going to be doing is completing the accounting cycle. So we're going to start from the very beginning of the accounting period and go all the way to the end of the accounting period. We're going to cover all the steps of the accounting cycle in this problem. So first of all, you need to read the information about this problem. For the past several years, Jeff Horton has operated a part-time consulting business from his home. As of April 1st, 2019, Jeff decided to move to a rented quarters and operate the business, which is to be known as Rosebud Consulting, on a full-time basis. Rosebud Consulting entered into the following transactions during April. So we're going to start this, even though it was a part-time business before, we're going to just start all over again as if this were a brand new business. We're going to start by preparing the journal entries for the month of April. And we're going to start with the April 1st transaction. And it says that the following assets were received from Jeff Horton. Jeff Horton is the owner of the business. He's given the business some cash to start with. He had some accounts receivable that he was contributing to this business, some supplies and office equipment, and there were no liabilities that were received in. So the only thing he's doing is he's contributing cash and other assets to his business. So this is going to be a compound entry, which means we're going to have more than 2 accounts involved. We're going to, first of all, debit the cash account to this business. So I'm going to go to my journal. In the journal, I'm going to choose my cash account. Skip your post reference. We're not going to use that post reference until we post these transactions to the ledger. Right now, we're just journalizing transactions because Jeff Horton, the owner, gave the business some cash of $20,000. Our cash account is increasing by $20,000. So we're going to put this on the debit side of this transaction. The owner also gave the business some accounts receivable, and the accounts receivable was valued at $14,700. So my accounts receivable is going to be debited for $14,700. And then he also gave the business $3,300 of supplies. So we had some supplies that we started this company with. And the amount of the supplies was given at $3,300. He also contributed some equipment to the business for $12,000. So my equipment is debited. For the amount of $12,000. And then we're going to have one credit to this journal entry for the capital account. The capital account has to be credited for all of the assets that were invested in the business. This is an example where the owner has invested more assets than just cash in the business. So it's what we call a compound entry. So we're going to add all of these together to get the credit that would go into capital, because capital is increasing here. So I'm going to pull out my calculator and I'm going to add these things together. I'm going to start with 20,000. I'm going to add to that 14,700, 3,300, and then 12,000. All of these total up to be 50,000. That's a credit to my capital account. And if you want to, you can check your work when you're doing these transactions. And you can see here that we got this first transaction right. So this first transaction was where the owner was putting some assets into the business. They put in cash, accounts receivable, supplies, and office equipment. All of these accounts are debits because they're asset accounts. The asset accounts are increasing because the owner has given them to the business. They now are the business's asset accounts. And the owner is going to take credit for those assets that he gave for a total amount of $50,000. The owner's capital has increased because the owner made an investment in the business. The second transaction was also for April the 1st. In this transaction, they paid 3 months rent on a lease rental contract. Now, when you pay rent in advance, it's what we call prepaid rent. So because we paid 3 months rent in advance, we're going to debit our prepaid rent for $6,000. Because we paid for that rent of $6,000, we're going to credit our cash account because the cash went down here. So my credit will be to cash for $6,000. And I would check my work. My next transaction is on April the 2nd. We paid the premium on property casualty insurance policies for $4,200. And so we're going to debit our prepaid insurance for $4,200, and we're going to credit cash. On the next transaction, which was April the 4th, we received cash from clients as an advance payment for services to be provided and recorded. It is recorded as unearned fees for $9,400. Anytime you receive cash, your cash is going to be debited. So my cash is going to be debited for the amount that I have received, which is $9,400. I'm going to credit my unearned fees for $9,400. And I'm going to check my work. All right, and then the next transaction, we are purchasing additional office equipment on account. So class, I have emergency here at my house I need to check on for just a second. So I'm going to try to pause this if you don't mind. And let me see if I can stop it for just a minute till I can get this straight at what's going on with the house. Okay, I think I got that disaster averted now. So bear with me as I try to share my screen with you again. Okay. All right, now where were we here? Gotta love this technology. All right, April the 5th. We purchased additional office equipment on account from Smith Office Supply Company, $8,000. Well, we're buying office equipment here. So our office equipment account, which is an asset account, is going to be increasing. So we're going to debit our office equipment account by the amount that we have purchased. And we purchased $8,000 worth of equipment. In this transaction, it said that we bought it on account, so our liabilities, accounts payable, will be increasing. To increase in liability, we would credit. And so we're ready to do the next transaction, which is April the 6th transaction. And on April the 6th, we received cash from our clients on account at $11,700. Anytime you receive cash, your cash is increasing. You've received it on account, so your accounts receivable is decreasing. To decrease accounts receivable, we would credit it. To increase cash, we would debit it. The amount that we received from this transaction is $11,700. And we'll check our work. Class, you don't have to check your work after each transaction like I'm doing here, but it is a good idea to check your work once you get through with your journal entries, because this journal entries feed into the ledger that you're going to have to post to, and it'd be a really good idea to make sure all your journal entries are correct before you post to your ledger. So in the next transaction, April the 10th, we paid cash for a newspaper advertisement. So our advertising expense would be debited, and I don't see an advertising expense here. All right, so I think in this problem, they're going to put some of the things in a miscellaneous account if they didn't have an advertising account. And do you see here, they have a list of accounts that they've given you. The reason I know this is I don't see advertising expense here. So it must be that advertising expense is probably an expense that doesn't happen that often. So we're going to go ahead and throw it in miscellaneous. So the newspaper advertisement is going to go into miscellaneous expense for $350. And let's look at that transaction again on April the 10th to see if we paid cash for it. We did. We paid cash, so our cash is decreasing. So on this transaction, we debited miscellaneous expense. We're going to credit the cash for $350. And I'm going to check my work. And so what I've learned from this is that in this problem, advertising expense is going to be considered a miscellaneous expense. Evidently, it was not an expense that we incur very often. But if we were in the business where we were advertising a lot, we could have set up a separate account and called it advertising expense. But in this situation, we didn't have an advertising expense to choose from. Again, these are the list of accounts that you have to choose from. So if you don't see something in there, throw it all in miscellaneous. Okay. So on the next transaction on the 12th, we paid Smith Office Supply Company for part of the debt that we incurred on April the 5th. You remember we went into debt when we bought some office equipment here, so we're paying off part of that. And when we pay when we pay off part of a debt, our accounts payable is going to be reduced, or our debt is going to go down. And the amount that it's going to go down for is $6,400. So we're going to debit accounts payable here, and we're going to credit our cash for the amount that we paid toward this debt. And it says that we paid $6,400 for that. So $6,400 is the amount that's going to go in as a debit to accounts payable and as a credit to cash. Our accounts payable, which is a liability, is being reduced. To reduce a liability, we would debit. Our cash account, which is an asset, is being reduced to. And to reduce cash, we would credit. So we're ready for the April 12th transaction. On April the 12th, we provided services on account for the period of April 1st through the 12th, $21,900. Anytime we provide services on account, our accounts receivable is going to increase. Our revenue account will be increasing also. Our revenue account is called fees earned. That's going to be our credit, but our debit will be to accounts receivable. So we're going to debit accounts receivable because our assets have increased. We're going to credit our fees earned for the amount of the fees that we've earned during this period of time, which was $21,900. On April the 14th, we are going to pay our receptionist a 2-week salary of $16.50. So we should have a salary expense that we are debiting here. And the amount that we're going to debit is $16.50. And we're going to credit our cash account for $16.50. And you're going to check your work. And as you can see, we've got everything on the first page recorded properly. So we're just going to move to page 2 of the journal. On page 2 of the journal, the first transaction we're going to record is that we have received cash from cash clients for fees that were earned during the period of April 1st through the 16th. So if we've received some cash, we're going to debit our cash, and they were from cash clients. So that means that it wasn't on account, that we're just going to record our revenue there. So it's cash paying customers. We're going to debit our cash for $6,600. And we're going to credit our fees earned for $6,600. And we're going to check our work. On April the 18th, we paid cash for supplies at $725. Our supplies is increasing, so we're going to debit it. And we are going to credit our cash for $725. And now we're ready for April the 20th. And on April the 20th, we provided services, this time on account, for the period of April 13th through the 20th. So anytime we provide services, our fees will increase, and they increase on the credit side for $16,800. Because these were services that were provided on account, our accounts receivable has to go up. Our fees earned has to go up also. And the amount of the fees that we've earned during that period of time are $16,800. And we're ready to move to the April 24th transaction. On April the 24th, we received cash from clients for fees earned for the period April 17th through the 24th. So again, we received cash from cash clients. That means that these clients were not on account. They just bought some services and paid cash for it. So we're going to debit our cash for $4,450. And we're going to credit our fees earned for $4,450. And we're going to check our work. So on April the 26th, we have received cash from clients that were on account. So this time we're going to debit our cash for $26,500, and we're going to credit accounts receivable because part of those customers that we sent invoices to have now paid us. So we're going to receive cash for $26,500. And we're going to credit accounts receivable for $26,500. Then we're ready to look at the 27th entry, the journal entry for the 27th of April. We paid the receptionist for 2 weeks' salary, $16.50. So we're going to debit our salary expense for $16.50, and we're going to credit our cash for $16.50. And then we're going to move to April 29th transaction. And on April 29th, we paid a telephone bill for $540. And I don't see a telephone expense down here. So again, I'm going to throw this in miscellaneous expense. So the telephone bill of $540 is going to go in miscellaneous expense. And again, they could have recorded a telephone expense if they wanted to, but they chose not to for whatever reason here. And I'm assuming that we're paying for that. Probably shouldn't assume anything, should make sure it's correct. But, we're doing a lot of flipping up and down, so I'll try to eliminate a little bit of that. So you can see that this is correct the way they wanted you to put that. So in this problem, advertising expense and telephone expense is included in miscellaneous expense. And we're going to move on to the April 30th transaction. It's the first one where we're paying an electricity bill. And that would be some type of utilities type of expense. But again, here I don't see utilities. I don't see anything that we could put that in. So I guess we'll just throw that in miscellaneous too. So again, you could have used utilities if you wanted to. But in this case, they just threw it into miscellaneous, I believe. So let me see what they've got down here for us to choose from. Yeah, that's the only thing that could work. And we will credit our cash again. And the amount of that electricity bill was $760. So we're going to check our work. And then we're going to move that on up to April the 30th. And it's the second April 30th transaction. We're receiving cash, and they again are from cash clients for fees that were earned. So when we receive the cash, we got to debit our cash, and we've got to credit fees earned because these were not fees that were from clients that were on account. They're cash clients. So we have some cash fees here. So we're going to debit cash and credit fees earned, and the amount was $51.60. All right, so on the next April 30th transaction, we are providing services on account for the remainder of April. They're on account, so we're going to charge our customers or we're going to send them an invoice. So it's going to be accounts receivable, and it's also going to be fees earned for $25.90. And one more journal entry in this first part. It says Jeff, who is our owner, withdrew $18,000 for personal use. We're going to debit the withdrawals or the drawing account, and we're going to credit our cash for the amount he withdrew, which was $18,000. I had to double check that. That's a lot for him to take out. Must have a lot of personal expenses to pay for. And then I'm going to check my work again on this last one here for the original entries. These are what I like to call original entries. They're the day-to-day entries that you're going to run into on a daily basis. And you can see here that we've got all of our journal entries recorded. We recorded them in 2 separate journal pages because there were a lot of transactions. And that's the first part for requirement number 1 that they wanted you to do in this problem. So as you can see here, they wanted you to journalize each transaction in chronological order. That means it's by date in the 2-column journal starting on page 1. This is what we did. We just got through doing that. And they want you to refer to your chart of accounts. This is your chart of accounts here. So you needed that, especially when you had to throw some of those special accounts in your miscellaneous expense account. So we're through with requirement number 1. And so we want to move on to requirement number 2. Now, you can guess that once we've journalized our original transactions, the next step is posting. So we're going to be posting the transactions to the ledger. So I want you to read part 2 carefully. It says post the transactions from part 1 to the general ledger in the attached spreadsheet. Posting must be in chronological order. That means it's by date. And be sure to go back and enter the appropriate posting reference in the journal. You'll remember that when we entered our transactions in the journal, we skipped over this post reference. And there was a reason for that, because when we're in the posting process, this post reference serves as a cross-reference with the account number in our general ledger. So what they want you to do is they want you to click on the attached spreadsheet. So you should have a bar up here in problem 4.5a that says spreadsheet, or it might say ledger, but click on this spreadsheet so that you can get it to open up. So if you'll hold on with me, see if this thing is going to open up for me. Well, anyway, that's where you click on it to make it open up. So I think it's just because we're in Zoom, it won't do that right now for me, you know, in real time. But you click on your spreadsheet and it should open up for you. And what I'm going to do is I'm going to stop sharing for just a second so I can pull up that spreadsheet for you so you can see what we're going to be doing. We're going to be posting these journal entries that we just created to that spreadsheet account. So I'm going to stop my share for just a second. I'll go back to share screen and let me see if I can pull that thing up. Okay, so when you clicked on that spreadsheet, this is what should open up. This is your general ledger. And on this general ledger page here, you can see we have the cash account, accounts receivable. We have all the accounts in the ledger. These are all our general ledger accounts. And you're going to be copying into this general ledger the things that happened from your journal. And you'll remember one of the first things happened to the cash account on the journal in the journal entry for the April 1st transaction, that we had a debit to the cash account. And this is the cash account, this is your general ledger. You would be copying it from the journal. So let me see if I can go back to the journal and show you where we're copying from. This is not the best situation in this Zoom account because I can't go back and forth between these like I want to. So I'm going to stop sharing again. I'm going to share my screen with you, and I'm going to pop back over to the Cengage screen. It's right here. This is cash. We've got to record that in our ledger account, and the amount is $20,000. So if you'll bear with me just a second, I'm gonna write these down, and I hope that you can see what we're doing here. That might not be the best idea in the world, but I'm gonna try to do this with you like this. See, it'd be very simple if we're in the class, we just switch right over to the general ledger and start posting these things. So this might take me just a second. Just bear with me. All right, now, so when we post, we copy from the journal. This is journal page 1 that we're talking about right now. We're going to go to our ledger account, which is our cash account. So I'm going to stop sharing the screen with you. And I'm going to share it again when we get to our ledger here. Okay. And then I'm going to put in my post reference, which is journal page 1. So page number 1 goes there. That's journal page 1. This is where we're getting it from. We're putting in a debit for $20,000. And that debit will cause the balance of the cash account to be debited for $20,000. You're going to pick up your account number, which is 11, and we're going to go back to our journal. And we're going to put that 11 right here. This is the process that we call posting. Then we're going to go to our accounts receivable account and we're going to put in 14,700. So I'm going to stop sharing. We're going to go back to the ledger account and I'm going to scroll down to my accounts receivable. I'm going to put in page number 1 for my journal. I'm going to put in a debit of 14,700. And that's going to be a debit balance to my accounts receivable. And I'm going to pick up 1-2. And I'm going to put that back in my journal. Remember, this is how we post it. The next account that I'm going to pick up is my supplies account. I'm going to go to my general ledger. And I'm going to put in my supplies account, journal page 1. I'm going to debit this account for 3,300. It's a debit balance. And 1-4 is going to go in my journal. This is how we post. Office equipment would be next for 12,000. So I had to find my office equipment. I put in my post reference. I'm going to debit my office equipment for 12,000. And it's going to have a debit balance. Then I'm going to pick up the account number, which is 1-8. And then on this journal entry, the capital account would be credited for 50,000. And so I'm going to go to my ledger. I'm going to put journal page 1 for my post reference. Notice I'm on capital, so my capital account has to be credited. And it was credited for $50,000, and the balance will be a credit balance of $50,000. Pick up your account number 31. And this is how we post. I'll probably do a couple more with you, and then I'm going to stop sharing this and just go ahead and post everything to save us a little bit of time. I don't want this to get so monotonous for you, but there is a process to posting, and it's very important that you understand how to post. So the next account that I'm going to look for is prepaid rent. And my prepaid rent was debited for 6,000. I'm going to credit my cash for 6,000. So I'm going to stop sharing. I'm going to look for my prepaid rent, which is an asset, so it's going to be toward the top of the page. Journal page 1. I'm going to debit my prepaid rent for $6,000. It's going to have a debit balance of $6,000. 15 is what I'm going to put in my journal. So we're going back to the journal, and we're going to put 15 in there. Then we're going to go to our cash account. This is the second transaction that would be posted to the cash account. It came from journal page 1. The cash account this time was going to be credited for $6,000. So you need to keep up with the running balance of your cash account. What you're going to do is you're going to take $20,000 and subtract $6,000 from that to get the running balance amount of $14,000. Pick up your 1-1. And you're going to put it in your journal, and you're through posting the second April 1st transaction. So as you can see, this is how you post, and you would post each one of your journal entries in the same way. So I'm going to stop sharing this with you, and I'm going to come back and I'm going to show you my finished posted journal at this point in time. So that's how you post to your ledger account, and we're on part 2, or requirement number 2 of this. You're going to post all of the transactions to the general ledger. So all the transactions that we just did have to be posted to the general ledger. So I'm going to pause my recording again.